$10,000 is still a realistic estimate. I said some time ago it was 5. It got to 5. That got smashed down a little bit. It's kind of working its way back to 5,000 in stages. But yeah, it'll go along with the kind of inflation that we talked about, and the things we talked about earlier in the segment, Michelle. Central bank demand is not going away. Supply is flat. Central bank demand is going up. It is true that central banks are buying more gold. You're absolutely right about that. And I think you framed it exactly right. The contest is the dollar and gold. It's not the dollar right now. The euro is about $1.16. It was $1.16. In other words, 25 years later, the euro dollar exchange rate is exactly where it is. Now it's bounced around. It was up to $1.60. It was down to 80 cents. It was like a great time to vacation in Europe. I understand that there's volatility. You can make or lose money trading. It's right where it was 25 years ago. There's no de-dollarization in the currency markets. Gold is different, and I agree with you completely.
The argument for a significant gold revaluation is no longer on the periphery. Rather, it is starting to make sense given the increasing strain on the world financial system. Jim Rickards claims that necessity, not speculation, is what is driving the route toward $10,000 in gold. Gold is subtly making a comeback to the core of the monetary system as government debt levels soar and trust in fiat currencies declines. What makes this shift so powerful is not just price momentum, but structure. Central banks around the world are aggressively accumulating physical gold while reducing exposure to U.S. treasuries. This is not a short-term trade, it's a strategic realignment designed to protect national wealth from sanctions, inflation, and systemic risk. As geopolitical tensions intensify and financial markets show increasing signs of fragility, the foundation of the dollar-based system is being tested like never before. In this environment, gold is not just an investment, it is emerging as the ultimate form of financial insurance in a world edging closer to monetary reset.
It is true that central banks are buying more gold. You're absolutely right about that. And I think you framed it exactly right. The contest is the dollar and gold. It's not the dollar right now. The euro is about $1.16. You know what the euro was when it was launched in 2000? It was $1.16. In other words, 25 years later, the euro dollar exchange rate is exactly where it is. Now it's bounced around. It was up to $1.60. It was down to 80 cents. It was like a great time to vacation in Europe. I understand that there's volatility. You can make or lose money trading. It's right where it was 25 years ago. There's no de-dollarization in the currency markets. Gold is different, and I agree with you completely. But what's going on with the dollar is not de-dollarization, except central banks are buying more gold. When central banks are selling treasuries, which they are, there's the Treasury has a monthly report on international currency holdings. It's a spreadsheet, and it shows you all the countries and how much they own in treasuries. Countries are selling treasuries, but they're not dumping them to get out of them. They wish they had more. They're selling them because they need dollars. Again, a security is not a currency. It's denominated in a currency. A U.S. Treasury security is denominated in dollars, but it's not a dollar. If you need dollars, you got to sell the treasury, get the dollars. What are they doing with the dollars? They're propping up their own currencies, and they're propping up their banks, and they're dealing with credit crises, whether it's real estate in China or a private credit in the United States. So there's actually a global dollar shortage and the beginnings of a global dollar liquidity crisis. And the reason people are selling treasuries is not because they hate treasuries. It's because they need the dollars to prop up their banking system and pay off bad debts. And by the way, gold is having a nice bounce back. It's kind of rallying here. You're right about that. But it kind of got smashed from around 5,400 down to 4,700 in a matter of a week or so. What was that all about? Again, that wasn't I hate gold. That was people sold gold because they needed cash. And this is symptomatic of this liquidity crisis. So we're not looking at de-dollarization versus other currencies. We are looking at increases in gold. You're absolutely right about that. But the bigger play is there's a global dollar shortage. We may be walking into a buzzsaw in terms of a global liquidity crisis. And by the way, Michelle, that has been happening for a while. That's been playing out for a couple of years. If there were no war in Iran, and we were doing this interview, we'd be talking about that as a separate problem. The fact that you've got a dollar liquidity crisis, a private credit meltdown, and a war in Iran all at the same time is extremely concerning. And we could be looking at best, a recession and perhaps something much worse.
in light of this conflict, where do you see gold ending this year?
$10,000 is still a realistic estimate. I said some time ago it was 5. It got to 5. It got smashed down a little bit. It's kind of working its way back to 5,000 in stages. But yeah, it'll go along with the kind of inflation that we talked about, and the things we talked about earlier in the segment, Michelle. Central bank demand is not going away. Supply is flat. Central bank demand is going up. The safe haven asset attractiveness of it is going up. To the extent people do want to, I sort of poured cold water on the de-dollarization thesis, but the idea that central banks are moving from dollars to gold, that's true. That's very well documented. So that will continue to drive it. And then I did the very simple bit of math where I pointed out that if you use $1,000 increment as a marker, each $1,000 increment is easier than the one before because you're working off a higher base. So it's a smaller percentage gain. So going from 4,000 to 5,000 dollars an ounce is a 25% increase. That's a heavy lift. But going from 9,000 to 10,000 is only an 11% increase. That's much easier. So you kind of struggle. I don't know if it's the right word. You kind of struggle, or it'll take time to get to 6 or 7, but you're going to go 8, 9, 10 really quickly. I see problems in the global monetary system with or without the conflict. So I'm not sanguine about it. I think there's a lot of trouble in the global monetary system. The private credit meltdown, the central banks going to gold instead of dollars, a global dollar shortage because the banks are pulling in their horns. All of those are problems. The Iran war is kind of an overlay on that. So I think it makes it worse. I would say we have a global monetary problem anyway, but the war makes it worse because of the increase, not just the increase in the price of oil, but the supply. The U.S. is not going to run out of oil. We got plenty, but the rest of the world, South Korea, Japan, China, others, they're going to see supply shortages. They already are.
The global economy is being squeezed by a serious shortage of dollars, creating what some call a liquidity crunch. Even though the euro-dollar exchange rate has stayed relatively stable over time, the real issue is happening behind the scenes. Central banks are selling U.S. treasuries not because they've lost trust in them, but because they urgently need cash dollars. These dollars are being used to support their banking systems and deal with financial stress, including problems like China's real estate downturn. The recent decline in gold prices from roughly $5,400 to $4,700 does not indicate that investors have lost faith in the metal. It's more about getting money fast when things are tight. Even robust assets are sold to meet urgent requirements during such times. When you combine a global dollar shortage, rising risks in private credit markets, and geopolitical tensions such as those involving Iran, it creates a highly unstable environment. In that kind of situation, gold still plays a key role. It remains a trusted reserve asset, even as the financial system struggles with limited liquidity and growing uncertainty.
Get to the Fed, but in terms of the stock market, for example, the idea that the stock market is an efficient information machine and discounter of future news is nonsense. That's like AKA Eugene Fama. They all won Nobel Prizes for things that are nonsense. Stock markets are very inefficient. They run on emotion. They don't adjust gradually. They gap up, they gap down. There's volatility, etc. So right now, my view of the stock market is that stock markets, and to some extent bond markets, have not discounted what we're talking about. There's the narrative that Wall Street's on, and what the stock market, the market is what it is. I mean, you can't really fight the market in that sense, but there's that based on a narrative, and then there's the reality. Reality always wins, but it can take time. So how many analysts on Wall Street have you heard saying, well, we think the war will be over in 2 to 3 weeks. The war will be over in 2 to 3 weeks. But they've been saying that for 9 weeks. I mean, that's my point. It's like, how many times do you say 2 to 3 weeks, and the 3 weeks go by and you're still fighting when you're like, oh, you know what? Maybe this is going to last for years. Maybe this damage is going to take 6 months to a year to repair. Maybe when you start shutting down refineries, it's not like throwing a switch. You can't turn them on just because the oil shows up. The amount of what you have to do to get that, to prepare that kind of infrastructure to be used again after it's been shut down is enormous. And so that's already baked in the pie. Like I say, even if peace broke out tomorrow, which I don't expect, the damage has already been done, and it's just the markets haven't reflected that yet. Yeah, Fed money printing is so-called is kind of irrelevant. The Fed's mostly irrelevant to everything we're talking about. The I'll kind of spend a minute on how the Fed creates money, and they do create money. You're right about that. So how does the Fed create money? How do they print money? Well, what they do is they have an open market trading desk in New York, and they call up the primary dealers. That's Goldman Sachs and Morgan Stanley and Citi and JP Morgan and all the big banks. And they say, offer me 5-year notes. And the trading desk offers them 5-year notes. Done. The bank sends the 5-year notes to the Fed, and the Fed sends money to, I'll say Goldman Sachs and Morgan Stanley. And that money does come out of thin air. So that's true. But then the question is, what does the bank do with the money? The bank that just sold the Fed the securities, what do they do with the money? They give it back to the Fed in the form of excess reserves. The Fed's a bank, and you can have an account there if you're a member of the Federal Reserve System, and they just give it back to them. That money doesn't go anywhere. It doesn't get lent. It doesn't get spent. It's not stimulating. It actually doesn't cause inflation. It just sits there. It's sterilized on the Fed's balance sheet. Okay. Where does the money come from that does do the things you're raising, that does cause inflation, that does, help the economy or contract the economy? That money comes from the commercial banks. It comes from JP Morgan, the Citi, and, Bank of America and Wells Fargo and all the rest. What are they doing? They can print money too, by the way. People don't understand that. If I go to a bank and take out a loan, and they put, okay, I sign a note and say, okay, Jim, here's your loan, and they put the money in my account. Where's that money come from? It's ledger money. It comes from thin air. In other words, the banks can create money the same as the Fed, but in that case, I probably borrow the money for a reason, and I'll probably go invest it or spend it or run a business, do something with it. That's the money that counts. So what are the commercial banks doing in that vein? Well, they're doing the opposite of what you suggest. They're tightening credit. They're concerned. They're going to have write-downs from the private credit crisis. They're going to have customers to go bankrupt because the higher price of oil, or the higher price of oil is going to cause people to spend more money at the pump, which means they'll spend less money at the grocery store or entertainment or vacations or clothes or new cars or whatever else it is. That part of the economy, again, where the money actually comes from, that's in retreat. So the Fed is mostly irrelevant. Fed money printing, it does exist, but it doesn't matter because it all stays on the balance sheet. You have to look at the commercial banks, and they're pulling in their horns.
Although it is true that central banks are purchasing more gold, Jim Rickards clarifies that this does not imply that the US dollar is being abandoned in favor of other currencies. He makes the point that big currencies, such as the euro, haven't fully taken the role of the dollar. In actuality, the euro's value in relation to the dollar is about the same as it was over 20 years ago. That reveals something crucial. The dollar continues to dominate international currency markets in spite of all the hype about de-dollarization. But according to Rickards, the true change is occurring with gold. Because gold is a new kind of money that isn't dependent on any one nation's financial system, central banks are gradually building up their gold holdings rather than moving to another currency. Concurrently, nations are selling U.S. treasuries, but not because they no longer have faith in them. Rather, they are acting out of necessity. According to Rickards, this points to a much bigger issue, a global shortage of U.S. dollars. Countries need dollars to support their own currencies, stabilize their banking systems, and deal with financial problems like debt crises or collapsing real estate markets. This is why they're liquidating assets, even gold at times. He explains that when gold dropped sharply in price, it wasn't because people suddenly lost faith in it. It was because they urgently needed cash, and gold is one of the easiest assets to sell quickly. That kind of behavior is a clear sign of a liquidity crisis.